Hey everyone, welcome to Finances with Ferg, episode 5. This one is on life insurance, a very commonly underutilized, even more so misunderstood concept, specifically around why are we talking about life insurance when it comes to finances. You will find out today it's probably the most important concept that we will talk about to ensure that you are protected and so are your loved ones should something unforeseen happen or should you pass away. Okay. In similar fashion, we're going to burn past the housekeeping because you've probably already heard this a million times. But the idea being that we talk about a lot of different topics. You can find me online. Anybody can find value in these. Any Canadians anyway. Yeah, tell your friends because we love to have giveaways going on here. But what are we specifically going to be talking about today? First, little play on words here. We're going to talk about timing versus time in the market and why it's more important to be consistently putting money into the market rather than trying to time it and trying to beat it. Very difficult to do. I'm going to talk about what is life insurance and what is it used for, what types of life insurance are out there, how do you figure out how much you could need. What is mortgage life insurance? Maybe some of you have just bought a house or maybe you bought one previously. You've heard this term thrown around but never really understood what it is. We're going to talk about that and what your options are there. We're going to talk about life insurance from work. Many of you probably do have some sort of coverage through your place of employment. Going to talk about the pros of that, the cons of that, why that might not be enough coverage for you. And then, of course, at the end, well, does this make sense for you? Does this make sense for me? Do you actually need it? We'll talk about that as well. So a quick recap on where we came from last week and what we were talking about, I guess a couple weeks ago. I haven't posted in a little bit. Sorry about that. I've been a little busy, but basically what this slide is showing you here is the value of consistently investing and more specifically staying in the market as opposed to trying to play the market, trying to beat the market, and trying to time it. As you can see here on the top two, let me bring up my laser pointer here again. On the top two graphics here, and then the bottom left, you can see that these are trending upwards, and the bottom right, you can see it's trending downwards. What you're seeing here in the bottom right is if you just save your money, if you just put your money into a savings account and didn't do anything with it, you can see that the value of your money goes down considerably over time. On the other three graphics here, the top two and the bottom left here, you can see this is what happens to your money if you invest it. $10,000 over 40 years grows quite considerably and is how you actually start making money in the stock market. It's not by saving, and as you'll see in this next slide, it's not by trying to beat it either, right? It's about consistently getting into the market and staying into the market. So what you're looking at here is what happens when you just leave your money in the market, when you stay invested, as opposed to when you pull it out, you try to play it, and maybe you miss a couple of the best days in the market. You can see the considerable deterioration of the amount of money that you will have over time just by missing a few key days where the stock market has gone up. If you weren't invested on one of those good days, even just one day, look at that. It's a difference of $180,000, give or take. That is crazy. That is an expensive mistake. It may not seem like it today as we're investing $50, $100, $1,000 a month, whatever it might be, but that is the beauty of compound interest, right? Over time, it starts to exponentially grow, and that 10% becomes much larger. 10% on 100 isn't that much. 10% on 100,000. Now we're talking big bucks, right? So the point here, guys, is don't try to beat the stock market. Don't try to play the stock market. The idea is consistently on a monthly or bi-weekly, whatever works for you basis, you need to be putting money into the market and you need to stay invested. We are long-term investors here. We're not players. We're not playing any games. We're building towards financial freedom in our futures. Okay? What we're here to talk about today, life insurance, right? Now, what is it and what is it used for? Life insurance is protection against loss, okay? It is a contract between you and an insurance company where in exchange for your monthly premiums or your payments, whatever you want to call them, upon death, the insurance company will pay a lump sum of money or a death benefit to your loved ones, kids, your wife, your husband, family, friends, whatever, your beneficiaries. Okay, the people, gonna sound dark, the people that are benefiting financially from you having that policy. Okay. Some things to talk about, right? Why is it used? What is it used for? Usually, most of the time, it's going to be there first to pay off any debts and then your remaining taxes, right? So if you pass away and you have a mortgage, if you pass away and you've got a car payment, if you pass away and you're in debt for some reason, or you owe taxes, right? Like we all owe taxes for each year we're alive. Someone's going to need to pay those debts. Someone's going to need to pay those taxes. So what a life insurance policy can do is help cover those debts or help cover those final taxes. Can be used to take care of kids, right? Perfect scenario is, you've got family of 4, parents, 2 kids. The kids are 12 and 10. If one of the parents passes away prematurely, you can have life insurance policies to help pay for the kids going to school, to help pay for the first home for the kids, help them get a step ahead. As we all know, especially today, it is hard to get ahead as a young adult. Right? Many people are still living with their parents into the late 20s, even early 30s. Why not, for a few bucks a month, give your child a leg up, right? You can do that through a life insurance policy. Also used to cover final expenses, right? Funeral bills, cemetery, headstone, basically anything that comes into play with a funeral or with death. There are also different life insurance products out there that, should you pass away while traveling, basically travel insurance. Should you pass away while traveling, there can be arrangements made to bring the body home. There's a whole bunch of different stuff out there, but the idea being just another reason why someone might want to look at getting life insurance. Another thing is peace of mind. Don't overlook this, guys. There are a lot of stress that get brought on to people when they think about their future, when they think of leaving a legacy, when they think of taking care of their kids, when they think of like, well, what's going to happen to my family once I pass away? Getting a life insurance policy is going to take care of a lot of those stresses, right? Think of it this way, and this is what I tell my clients or anybody that asks me about life insurance. You work your entire life. Most of us will work our entire lives to try to get $1 million of savings or more. With the right life insurance policy for, and I'm not going to put any quotes out here, but for, a few tens of dollars, $50, $60, whatever it's going to be, you've got $1 million of coverage like that for the next 20, 30, etc. years, right? Life insurance is the only thing out there that can give you that much money that quickly. Now, unfortunately, you got to pass away to get it, but at least you're taking care of your family, you're taking care of whoever is left behind, okay? And this is one that's often overlooked as well. It can replace your income, right? These are things like disability insurance, critical illness, right? These are living benefits where if you get hurt and can't work anymore, or you get sick and can't bring in an income, you have an opportunity to get a policy that will actually replace your income. At the same time, if you're the sole breadwinner and you pass away, how is your husband, how is your wife going to continue supporting the family? They won't be able to, right? It'll be a massive change to their livelihood. So with a life insurance policy, you can actually replace that missing income now so that your family is not uprooted and their lives completely change for the worse, okay? The other thing is you can actually use life insurance policies as a tax shelter, right? There are certain policies out there that carry a cash value. Basically, it's like kind of similar to an investment where you can have life insurance, you can also have a cash value. You can start growing money in there tax deferred as another way to grow your wealth, another way to build up your retirement fund. Okay. Now, what affects the premium? Like, why would a premium be more expensive or why would a premium be less expensive? First thing is usually age, right? The older you are, it's going to be more expensive. Another thing is gender. Hands up, ladies. For once, you guys are paying less than us for something. Congratulations. If you are a woman, you actually pay less on your life insurance than a man would. Comparing all things considered, everything being equal. Smoking, if you're a smoker, I always just say expect a double a doubling in your rate, it does get considerably more expensive if you are a smoker. You do have the opportunity, though, to reapply with a lot of different policies with a lot of different companies, where even though you're a smoker now, if you get a policy and within a year or 2 years you decide to quit, you can actually go reapply and get that lesser monthly premium. If you have poor health or poor medical history, this will affect it as well. Basically, the healthier you are, the younger you are, the lower the premium you're going to pay. Vice versa, older, not as healthy. Same with lifestyle, and then driving record as well. If you've got a pretty crazy driving record, might be a little bit more expensive to get life insurance. Might be difficult to get life insurance. All things considered, though, or all things mentioned here, don't give up. Right? Let's say you've done one thing and it's too expensive, or gone to one place is too expensive. Say you've gone to one place and you can't get it. Let's say you've gotten sick. Let's say something's happened. There are almost always options out there for you. Please do not quit. Feel free to talk to me if you need someone to talk to, see what your options are. But too often do people stop after one attempt. This is such an important concept, guys. Please keep trying to get something out there if that's what you're looking for, if that's what you're needing. And then what's out there, right? What do you have? What do you have the ability to get? There's a lot, but for the most part, you're thinking term insurance, right? So this is a short-term policy that's going to cover you during your high debt carrying years. There's permanent. That's that tax shelter one, the one that kind of acts like an investment where you're covered for life, growing a cash value, and you can actually help supplement your retirement savings with that. Critical illness and disability, like I mentioned, if you get sick or if you get hurt and can't work, these policies can replace your income. And then there are riders. These are kind of like the fries with your insurance burger, little add-ons that can help you get different things should something happen. So for example, let's say you don't use the insurance policy, you can get what's called a return of premium, where all or a portion of what you've been paying will be returned back to you. There's accidental death and dismemberment, where if your arm gets chopped off, I know it's life insurance conversation, it's not the nicest one, but if something happens like that, you can get a return of your premium, you can get a payout. There's a lot of different things out there. The point being, there are a lot of options. Talk to someone who knows and see if there's something out there that'd be a good fit for you. Now, what are the main types? Basically going to go into detail about what I just kind of went into detail there. The two main types that you guys are probably going to be most concerned with, now unless you're a self-employed or an entrepreneur professional, you're also going to be very interested in disability and critical illness, those living benefits. But for the rest of us, let's see what we've got here. You've got term and permanent, okay? And a term policy is like renting, okay? Just like renting compared to owning a home or owning a mortgage, it's typically less expensive, right? The monthly premiums are going to be lower on a term policy. And what you're getting is coverage for a certain term, a certain amount of time. So think like 10 years, 20 years, 30 years, etc. Okay? With a term policy, if there's a death within the term, so if you die within those 30 years that you've chosen, there will be a death benefit. Your beneficiary will be paid out. Somebody will be getting a lump sum of money, okay? Now, problem with term insurance is if you die outside of that term, there will be no payout. So if you have a 30-year term and you die on the 31st year, there's no payout. That money you've paid over the last 30 years is gone. There will be no payout for your beneficiary, okay? Now, you can renew. Right, so let's say you bought a 20-year policy, and after 20 years, you're like, well, shoot, I'd still like coverage. Now I've got grandkids, I'd like to help them out, whatever the reason might be. You can renew, but you're now 20 years older, or you're 30 years older. You're probably not in as good of health as you were back when you got the policy originally. So you can renew, but it is quite expensive, okay? A term policy holds no cash value, so it's not helping you through retirement. It's not helping with tax sheltering. There's nothing really all that special about term insurance, but it is still a great low cost coverage when you're carrying high debt, when you're in those years of carrying high debt. Okay. Now looking over at the permanent side here. There we go. Looking over at the permanent side here, let's talk about some of the differences. Okay, if term is like renting, then a permanent policy is going to be like owning. That is your policy. What you're doing with it, the money you're putting into it is yours, right? You own it. Now it is typically more expensive. You're not typically, it is more expensive. Your monthly premiums will be more. It's not like 5 times, 100 times, anything crazy like that. Sometimes it's like 50% more, double, 75% more. Still more expensive, but nothing crazy. And you'll hear why in a little bit. It is a much more robust product. There are many more benefits to a permanent policy than a term policy. You're covered for life with a permanent policy. That's one benefit. No matter when you pass away, you will be paid out some amount of money agreed upon as you're putting the contract or putting the policy together. Coverage for life, death ever, death benefit, right? No matter when you die, you will get paid out. Your family, your beneficiary will get paid out. And there's no need to renew, right? Because it's coverage for life. This one's cool. This one builds a cash value, right? So there's an investment portion to a permanent policy where some of your monthly premiums going to the cost of insurance, some of your monthly premiums actually going into a tax deferred account. And that account is growing based on some investments or based on some dividends. You decide that with your advisor. And over time, you will have a lump sum of money built up where you can do a lot of things with it, right? You can cancel the policy and it's now paid for because you've got this lump sum of cash there. You can cash out that policy and use the money for whatever you want. You can take what's called a collateralized loan, where you go to the bank or you go to someone and say, hey, look, guys, I've got this permanent insurance policy with a cash value of $150K. I'd like $125,000, please. I'll pay you your 2% per month to do that. The whole you now have your 125, your 150 in your cash value in your permanent policy is still growing. So you're now accessing cash while still having cash. This is what the rich do. You don't pay taxes on loans, so you're getting $125,000 cash free. Pretty darn strategic. And then same, you can cancel a term without penalty. It's just you don't have coverage anymore. And then you can cancel or cash out a permanent policy. There's usually some sort of surrender charge or a tax or something. It's not just, hey, without penalty. There's usually something tied in there. But again, in my opinion, I think permanent policies are great. If you can afford one, I'd say they're definitely worth looking into. And you know what, if you're one of the people looking to leave a legacy, if you're one of the people looking to find another investment vehicle for you to get your money invested or a tax shelter, or if you're looking to, you'll hear a lot of Instagram influencers and famous people talking about, hey, what are the rich doing? Permanent policies are what the rich are doing. Okay, feel free to reach out if you have any questions and want to talk about it. Okay, guy, but how much do I need? All right, that's all great. Thank you so much for that. Finance with Ferg with Ryan Ferguson. But how much do I need as your listener and as your watcher? Well, let's kind of talk about the rule of thumb. As we've said many times, there are many rules of thumb in finance. Insurance is no different. So a good rule of thumb for understanding or figuring out how much you're going to need is to start anywhere between 10x to 20x your income. Okay. So for example, in French, for those of you that maybe have forgotten or didn't pay attention in French class, let's talk about a little scenario here. Okay, and how would you build out the amount of coverage for Becky? So Becky is married with a daughter. She makes $100,000, the same as her husband. She has a $750,000 mortgage. She owes $25,000 on her Lexus. She has $15,000 on her credit card and line of credit. Assuming that funeral costs are about $10,000 and her daughter's education will cost $50,000, how much does she need, right? Well, if you go back to thinking, or if you think back to what we talked about previously, we want to start at 10x, okay? So if we go 10x her income, that's going to be $1 million worth of coverage. Seeing as though she's going to have $850,000 worth of debt if she passes today or sometimes in the near future, we start doing some quick math here. Okay, so boom, $1 million to her beneficiary. That beneficiary will most likely pay off the debt. Why wouldn't you? So what that leaves the beneficiary, probably the husband, what that probably leaves the husband with is $150,000. Okay, now at this point, we start asking the question, Becky, would this be enough for you? Well, yeah, it's paying my debts. That's true, but you got to remember, Becky, that you have a $200,000 per year household. Now that you've passed away, that household is becoming a $100,000 household. do you want to provide your husband with an ongoing income to help support him, to help support Becky, or sort of help support the daughter? Start talking about these things. Oh, well, I never thought of it like that. Okay, well, let's go with the $1 million again. You've got $150,000 left. What we could do, once that pays out, put the $150,000 into an investment. If you remember my last video, we talked about the little budget box there, the TFSA and the RSP, and how it's got to go into the slots. We're putting them into the slots, okay? And that $150,000 will hopefully make 6% growth every year. And your husband is going to now withdraw that 6% along with it, all right? Now, what that's going to leave your husband in terms of an annual income is about $9,000 per year, or about $750 per month. Now, Becky, do you think that's enough for your husband and daughter to maintain the same lifestyle? Or would you be interested in having your husband and daughter maintain the same lifestyle? And if she says yes, great. If she's like, oh, you know what, we were actually just trying to cover the debt, awesome. She only needs $850, but maybe she does want to make sure that the husband is covered, the daughter is covered. They don't need to struggle or want for anything. She can up her coverage amount by $100,000 to ensure that this family gets an additional $500 per month. Okay, so this is typically the exercise that I would do with my customers to understand what they need. Now, of course, the first place we go is cover the debt. Maybe we don't need, or maybe we can't afford a policy to cover all the debt. That's why working with an advisor, conversing with them, making sure they understand your situation is so important. Too often do I hear of people going into institutions, usually banks, hey, I need a life insurance policy. Okay, great. Well, you know, how much of your monthly budget can you spare for it? 50 bucks. Okay, well, here's $300K in coverage and give me your 50 bucks a month. That might not be anything close to what you actually need, right? So it's important to sit down with an advisor and actually figure out what makes sense for you, and then you work with the budgetary numbers that way. So I've been hearing this thing out there, Ryan Ferguson, about mortgage life insurance. Well, what is that? Explain that to me. Well, mortgage life insurance is a form of insurance specifically designed to protect the repayment of a mortgage. Basically, if the policyholder dies, the policy would pay out a lump sum equal to the remainder of the mortgage. Okay, so what that means is if I've got a $500,000 mortgage and I pass away when there's $500,000 owing, the lump sum will go directly to the bank or the mortgage lender, whoever had the mortgage with me, whoever I had the mortgage with, and they're going to get that. There's nothing left over, nothing there. At the same time, though, let's say I had a $500,000 mortgage and it was down to $300 when I passed away. I'm not covered for $500,000. I'm covered for whatever is left on the mortgage. Okay. Now, those two little blips I gave you there are why I don't think this is the best thing out there. I'd say at bare minimum, if you're trying to cover the amount of your mortgage, you should at least go with a term life policy. And I'm going to talk to you why here right now. So here are some differences and some pros and cons between mortgage life insurance and actual life insurance, which is like the term policies, which we've just covered. The ideas being, life insurance is typically going to be cheaper than getting mortgage life insurance. So there's one. The other thing with life insurance, you control the policy. You are covered for, you get to choose the beneficiary, right? So it's your policy, you choose the beneficiary. It's your loved ones getting paid out. Mortgage life insurance, it's the banks or it's the lender getting paid out, okay? The other thing is you will have, lost my train of thought here. So it's going to be cheaper. Life insurance is going to be cheaper than mortgage coverage. It's your beneficiary, so it's your family that gets paid out. Oh, and the other thing is the reducing costs. So as I had mentioned, if you have a $500,000 mortgage and you've got mortgage life insurance, it's only going to pay what's remaining. So if you pass away with $200K left, only $200K is going to get paid out. If I've got a $500K mortgage and a $500K life insurance policy, no matter how much is left on my mortgage, let's say it gets down to $100 grand and I pass away, $500 grand will go to my beneficiaries. And the cost has remained the same, less than the mortgage life insurance. Okay? what I always recommend to my clients is when you get a mortgage, make sure you look through the agreement and they haven't snuck in some mortgage life insurance. That will happen sometimes. You do not want it, right? Try to get a term life insurance policy instead. It's better than nothing, right? I would recommend that a mortgage life insurance is better than nothing. But if you're going to get one or the other, I'd recommend always going life, okay? Let's talk about work, right? A lot of you are going to be having, or a lot of you are going to have policies, disability coverage, life insurance coverage through work. It's convenient, it's easy, it's free most of the time, right? Your employer will pay for it. But let me tell you why it might not be enough. And now when I'm saying not enough, it doesn't mean it's not good, and it doesn't mean you shouldn't have it. But I'm just saying you might want to supplement it, or at least look into supplementing it depending on your situation. Okay, like I said, it's free insurance. Work is probably covering your premiums. That's awesome. Keep that free insurance. Why wouldn't you? It is typically cheaper, right? So if you are going to end up having to pay through work, it will probably be cheaper than going to a private provider. Why? Because you're part of a group plan. You're getting a group discount. Okay. Here are some of the problems. Okay. It's usually not enough coverage, right? So most employers will provide their employees with about 1 to 2 times their salary in coverage. As you saw previously in the industry, in the financial planning industry, in the insurance industry, we typically recommend starting at 10x. Again, it's not mandatory by any means, but that's typically where we find the sweet spot to have people cover their debts and provide a little bit left over for their family. So 1 to 2 might not be enough. The other thing is your policy is tied to your employment. So what that means is if you quit or if you're fired, you are now no longer covered. Yes, you will get covered from your next place of employment if you get it. But again, it's only going to be 1 to 2 times salary. And from that time, from when you quit or were fired to when you got your new job, you weren't covered, right? The odds of it happening are low, but again, the whole point of life insurance are for those low odds, right? It's to cover the anything. It's to protect yourself. There aren't as many it's not as flexible, there aren't as many options typically through a group plan, and that's just kind of how they're designed. It's cheap, it's convenient, there it is. And then the other thing is you don't have control, right? So it is actually the employer who controls the policy. If they want to shut it down at any time, they can. A lot don't. But again, I'm the type of person where if I can have more control over my life and more control over something, I'm going to want that, right? Why would I want someone else to decide if my family's protected? Why would I want someone else to decide if I'm doing what's right by my family? I don't. So I go private and I try to get my own stuff. Okay. Now I will say this, I also have coverage through work. I have that, but I have supplemented it with some additional on the side. So you can do the same. All right. They sound pretty good. I kind of like what you're saying here, Ryan, but do I really need one, right? Like, would I be the type of person that would kind of need it? Here are some scenarios. Okay. Do you have kids? Whether they're in the womb or in the room, you need it, right? Protect your kids, help them go to school. Now, take the you need it with a grain of salt. It's always at the end of the day your choice, but this is my opinion. I think you need it if you've got kids. Okay, if you and your loved one or your spouse should pass away, that's a really bad situation, right? If there is no money left behind, that's a really bad situation. Do you own a home? You have a mortgage and any other homely debts? You probably need it, right? You probably don't want to leave that debt with a loved one. Are you in debt, right? Are you currently carrying debt alongside or outside of a mortgage? You will be leaving debt to your loved ones. You probably need it. Okay. Are you young and supple? Well, it'll never be cheaper, right? And as we mentioned, you can get a permanent policy. You can start using it as an investment. This is what I've done. I'd say think about it, right? No, you probably aren't carrying very many debts if you're young. No, you probably don't have too many responsibilities at this point. But you probably will, and if you can get it at a very cheap rate now, why not if you're going to need it in the future and if you can afford it, right? So think about it. Could be a good investment. Are you old, right? You're probably high risk to a low risk industry. Probably can't afford it. Now, when I'm saying old, I'm talking like retirement age, right? Like 40-year-olds, 50-year-olds, even 60-year-olds are still getting insurance, and some of them can still afford it. But as I said earlier in the call here, it does get considerably more expensive the older you get. So a lot of times if you hit a certain age, I'm thinking like 60, 65. It's probably not worth it, but again, always worth looking into at least. Are you the sole breadwinner, right? Are you the only one bringing in any money? If you are to pass away, how is your family going to make a living? Where's that income going to be coming from? You need it. You definitely need it. Are you a stay-at-home spouse, right? You might not be bringing in the income, but you do have a significant economic value to that family. You're taking care of the kids. You're driving everyone around. You're making meals. You're doing all the shopping. You're doing all the housework. You're doing everything that maybe that sole breadwinner isn't doing because they don't have time, or for whatever reason your family dynamic has it set up. I would say you still need it, right? If that stay-at-home parent passes away, this sole breadwinner is going to need to get babysitting. This sole breadwinner is going to maybe need to get a nanny. This sole breadwinner is going to need to figure out something. And if they don't have a lump sum of cash to help them do that, again, big lifestyle change for that family. Are you wealthy and do you expect to owe estate taxes? Again, it's kind of like the carrying a debt. Everyone's got to pay their taxes. So your family or someone will have to pay them. You'll probably need it. Right? This is why estate planning is so important early on in life, just like retirement planning. You got to do retirement planning and estate planning in like I'd say retirement planning is in your 20s and 30s, estate probably in your 30s, 40s. But this is the reason why, so that you're not passing on debt to loved ones. If funeral costs will be a burden and you don't think you could cover that one-time lump sum, again, might be a little bit expensive to get a policy, but might as well look into it. If $10,000 to $20,000 is just not an option for you, maybe $15 a month or $10 a month for 20 years does make more sense to you, right? You can do that instead. Are you a business owner, self-employed, entrepreneur, sole proprietor? Do you work for yourself? I think you need it, right? Not only the life insurance, not even the life insurance portion to cover if you pass away, but especially critical illness, disability insurance, those living benefits. Because again, if you are reliant on your income, if you don't have disability coverage, what's going to happen if you get sick or get hurt? You have to protect yourself. Okay, so I would say that yes, you do need it. And with that, guys, that's it. And my poorly built out slide at the end. Any questions, any comments, feel free to call, feel free to email, message me on Insta, Facebook, TikTok. Would love to have a chat. I find that this is one of the most important concepts that is constantly overlooked. So even if you just have a couple questions, want to understand what your options could be or what I'd recommend in your situation, at no charge. You guys are the Finance with Fergers. You guys get this stuff for free for being for tuning in. So have a great night, everybody, and appreciate you. Bye-bye.